p.m. We have a quorum. First, starting on our agenda item is to approve the minutes of Wednesday, May 25th, 2022. If I may ask you if you want to take a quick review of that and someone make a motion.
I'll make a motion to adopt.
All right. Thank you, Chris. A second?
I'll second.
Eric, a second. All in favor to approve the motion? Aye.
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 Okay, passed unanimously. Great. All right, we've got a lot of retirements this evening, including a very special one at the end. So Cheryl, you laid these out for us in two different batches. One is to review and approve the normal retirements for the following BOE employees. I'll name them. Nancy Albert, Elizabeth Bonney, Sheila Simpson, Louise Mazoros, Jose Cardenti, Amy Yazbak, and Sandra Skudlera. Why don't we start there? They all look normal. They all look regular, but I'll let you take it from here.
They're normal. Sandra, the last one, she was vested deferred. Other than that, these are all active employees.
Just real quick on the Jose one, why was it handwritten the same number next to his name? I don't know, just
That was
weird.
just because the salaries had just changed.
Okay. It was weird.
Okay.
And I was going to erase it, but then I thought, then it looks like something's missing.
Yeah, no, it's good. No,
It's just the way I think.
I got you.
Good. Okay. I thought all the paperwork for all of those were in fine order. The calculations all checked out to me.
That's anything crazy.
Okay. Someone like to make a motion to approve these retirements?
I'll make a motion to
Okay.
approve all the retirements.
Eric Newman's made the motion. A second?
I will second.
Chris will second. All right. All in favor? Say aye. Aye.
Aye.
Jack? Okay.
Yep,
Passes
aye.
unanimously.
Yep.
All right, that's the first step. Those are the BOE employees, guys. Thank you very much. Next up is to review and approve the normal retirements for the following town employees. We have Lynn D'Amato, Mary Ellen Lehman, Irene Stepanoff, and our good friend Cheryl Lynch. Cheryl, is there anything?
No, here as well, all normal. Everyone is currently active until August 1st.
All right. Someone like to make a motion? All the numbers all squared out in my book on this one too?
I'll make a motion to
Okay.
approve them all.
Eric made a motion. A second?
I will second.
All right. All in favor?
Aye.
Jack?
Aye. Yep.
Aye. All right, that's it. Passes unanimously. With that, I will call the meeting to adjourn at 6:49 p.m.
That's a record.
Wow. Nobody on police and
You
fire?
have no police and fire?
Yeah, we do have police.
Oh, I didn't, I mean, I don't.
We don't get those.
We don't get those. I just-
We're
No,
town,
you don't get those, and no one's here.
No one's here.
so.
That's why I thought, oh,
Wait,
we got one.
We got one.
Jared.
Hi.
How are you?
So Cheryl, congratulations.
Thank
Yes,
you.
congratulations.
long time coming.
Hey.
Long time coming. A lot of years to work.
Thought you were calling in. You decided not to?
I changed my mind.
Oh.
Oh, so you just let me set this all up myself.
You did a great job.
You do a great job. She's good at
It got done,
that
right?
stuff.
Mm-hmm.
Well, we just went through, town side's done, all those retirements.
All right.
Waiting for
All good.
police and fire.
That was painless, thank you.
Well, that was easy math.
Yeah.
Thank you. Right?
Yeah, wasn't
Easy
too nuts. I thought there'd be more, but I guess not. I mean, it's a lot, but.
Yeah, you know, whenever we go through them and I look at the, you know, the paras and the sped aides, I mean, I just want to thank them. Like, it's
No, it's so true.
incredible work they do for very little.
Very little.
Very little, and they work for, I mean, and they do it for so many years.
Mhm.
And you just know they get up every single day and put their best foot forward.
No, I know.
You know,
Nick Caruso has called, join the league.
Nobody else here from fire and police?
no. You need one more.
Yeah.
If you get three, you have a quorum.
I didn't hear from
Who's missing?
Rick Caliper, Walter Burke, Russ Atkins,
Did you hear from Eric?
Russ Atkins, town.
Did not hear from Eric.
Jim Brown. What's Jim
Jim
Brown?
Brown.
Jim's on town.
He's town too.
No, you've got
Bruce
Nick,
Ryan?
Nick Caruso called in. Oh, Nick is here.
Nick's
One,
there.
two, we've got Nick, yourself, we're missing Tom Collmore, Bruce Ryan,
Eric
Caliper,
Caliper.
Walter Burke. Brenda can't make it.
Marilyn?
Nope,
Yeah, come on in.
Come on in.
glad you could make it.
Yeah.
Yeah, glad to see you all.
You take the whole day off to travel, huh?
Yeah, I don't mind the Amtrak.
Oh, I like it,
Yeah, it's packed.
yeah.
Is
Oh,
it?
Really?
Yeah.
Oh, there's like virtually no seats, yeah.
Mm.
I mean, yeah.
See, people are ready to travel.
Wow.
Is this your?
What time, what train
No, that's
did
a
you take?
classic.
I have never given it up.
That's awesome.
My HP 12C,
No,
I
that's,
love it.
that's
1:30 out of
pretty cool.
50.
Okay.
That's pretty
Yeah.
cool.
Wow.
Yeah.
You know, you can do, you know, your phone has about 50,000 times more processing power than the
Yeah.
calculator, but.
And you know, it's funny, I actually have this
It's on
this,
that.
I actually have the app on this, but nothing, I don't know, just nothing
Yeah,
beats
no,
the buttons.
it's still working.
You
It's so true.
must have had one or used one of those.
I do not use one. No, I know, Caitlin, and they have like the big buttons, you know,
Uh-huh.
that,
Yeah.
Yeah.
the adding machine.
But you never know when you need to calculate,
No, that's
you
right.
know, when you
That's
need to
the thing.
calculate a mortgage
Yep.
or some
Yep.
compound interest or something. I mean, it's just always here at your disposal.
Present value, yeah.
See, I'm a big time, I have to have a printing calculator
Printing calculator.
from when I was an an auditor. I always,
Tape.
Oh.
yeah, so you
Tape,
can check,
yeah,
It's
yep.
old
yeah.
tape that never actually gets ripped.
Connie has one of those.
Have a college student.
Mm.
Attach
That's
it to the
it,
bank,
so,
right?
you know, and you can do it like this, you don't even have to look at it, but it's there so you can
You have
see
a
it.
record of it, you know what the
Yep.
numbers were
Yeah.
that
Right.
entered. Yeah.
So
No.
it doesn't have the handle though, we have to crank it
No,
back.
yeah.
Ding, ding, ding. Ding, ding.
She's got version 2.0.
Right. Oh, boy.
No, I'll never give up my old HP 12C.
No, that's
Never
fine.
say never.
It is a classic.
Yeah, that's a great one.
It's a great calculator. And you know, once you get used to doing all the calculations backwards,
Well, no, yeah,
you can never go forward again.
But again, people don't remember, that's what HP started with calculators, that's what they're, and,
I
you
mean,
know,
I
instruments.
can't do 8 times 7 equals.
Right.
Times 8 enters 7 times. I mean, you can't
Yeah.
unlearn what you know,
Yep.
pounded into your brain.
Oh, no, you can't.
And
Okay.
Benjamin will be dialing in.
Mhm.
There's two people.
Okay, yep.
Courtney Hayes and, Mark, same two from, last year.
Okay?
Mark.
Thank you for
Lasry, the
coordinating that.
CEO, yeah. Mhm.
There's somebody.
Hey, who's joined us?
Well, Jack, no, Jack left us.
Jack left.
We're losing people?
Yeah.
That's not good.
Not good,
Isn't it?
not good.
The attrition.
You know,
I'm worried about the police and fire.
Yeah.
I know.
Are they going out this month, Cheryl?
They're going out July.
I know.
We'll have to do a special meeting.
Yeah. Yep. I'm surprised. Way to represent hometown side.
Exactly.
Yeah, I'm proud.
Now, I had Jim Brown on these emails, so everybody should be on here.
Got the correct email?
Yep,
Tom Collmore?
yep.
Mhm. I took that other email out.
Yeah. Hard.
That was like a campaign email, so I just, I got rid of that
Delete
one,
that.
yeah. Took off the whole site.
God, Eric
You know,
Caliper's usually
we've got to
there.
update the
Yeah, Eric's.
website, for, Jim Brown's not even listed as a member on the
No,
town
you're right,
website.
I noticed that.
Yeah, he's not, he
And
needs
Jen's
to-
not here,
And
because,
Jen's not here.
because I was gonna bring that to her attention.
Right, and we should
Is
probably
she the one that
list
does
the
it? The
J-RIB.
agenda does?
Yeah.
Carpenter?
Mm-hmm.
We used to list the J-RIB, which is a separate entity, because
Right.
we have a separate state of officers, but that's not listed anymore on the town website.
Oh, I'll talk to Jen.
Yeah. And
She's
we're-
probably back next week.
Sure, and then we should probably freshen up the minutes or the agenda, whatever.
Mm-hmm. That, yeah.
All our stuff in our little box. I have the worst case of poison ivy, you guys.
Ooh.
I have been,
That's rough.
I was gardening last week and it's all over,
Oh.
and it's like, in the evening, I just start to itch.
Oh.
So I'm really sorry if I can't really answer tonight.
To wear long sleeves a
Yeah,
lot?
look at what's.
Oh, yeah,
I'm
that's
like- I'm like,
mean.
I'm,
That's me.
Yeah.
oh,
Got it, good.
yeah, I had to go on full, oral steroids.
Sure.
This is Courtney, this
Days.
is your,
Yeah. Yep. Hi, Courtney.
It's nice to be here. Nice to see you all. I know I'm a couple minutes early, so I'll go on mute until Mark joins and you're ready for us.
Great, thank you. Thanks for joining us.
My pleasure. My pleasure. Thank you.
Doesn't feel like summer today.
No.
Oh, no. Longest day of the year.
Eric's gonna be here in 3 minutes,
Okay, all right,
Okay,
then,
so you'll
we're
have a
good.
quorum.
Light flashing or just,
then we'll have a quorum and, you can
All right.
do the retirement,
Mhm. That'd be great.
okay?
No Jim Brown, no Walter, Bruce, Tom?
No, and no notice.
I tell you, they sneak up, these meetings sneak up on you. I'm like, what? Another meeting? Didn't we just have one?
But usually people will say if they're not gonna make it.
Mm-hmm.
Yeah, yeah, generally I get a heads up. I hear a door. I hear a door.
I know you tune in, right?
Do we hear that door opening? Yeah.
Come on
Someone's
in,
coming.
come on in.
How many more do you need for a quorum?
Just one more.
Just
One
one.
more.
Okay.
I mean, we can have the meeting,
Right,
but they have, retirements to approve.
right.
So they need to have a quorum so they can approve the retirements.
Yeah, your meeting's safe, but not,
But yeah, we just made it.
And Bruce?
Hey, Bruce. All right, welcome.
All right.
Why don't you?
Yeah, how are you? Good to see you.
Bruce?
We are, delighted you're here. You make the quorum for the police and fire, and there are retirements awaiting.
And there's a lot of retirees that are really happy.
So, yes, you know, I wouldn't
Track
want
you down and find you.
wouldn't want them to be left waiting.
What do we need? We need 4, right?
Oh, you need 3. You're there.
You sure?
yeah, you're there.
You're 3. 3 for police and fire and 5 for town.
You just wanna wait 2 seconds for Eric.
Yeah.
The paperwork I sent by email.
Isn't it a majority? We have 7 on that. We have 7 on police and fire.
Yeah?
Oh, you didn't get it?
There you go, now I got it.
There we go, there's 4,
There's 4.
just to make sure.
It's not the majority.
That's okay.
So these are, and they're.
I know you
Oh,
normally
I
are
see what you're
here,
saying.
so.
Heather, I just
Wait for
kidding.
quorum.
Yeah.
Got it.
And,
Got it.
vote on this meeting,
So she can swing either way.
Yep,
okay?
all right.
Hey. All right, you've got to call your police and fire meeting together. You've got some retirements to,
got the minutes for me?
to take care of.
Do you have a copy of the
I just gave it to Bruce.
Here you go, Eric. Thank you, my friend.
agenda?
Okay, we'll call to,
Jim Brown is on the phone too.
this is not the agenda.
Everyone, just so we know, we're starting, we're running a little behind.
What do you need, the agenda?
We're gonna have the police and
Shall we have an
fire
agenda?
meeting real briefly,
No, I
and
sent
then,
it by email.
once that's done,
You
we'll
wanna,
roll
or
into
you
the.
want me to, you want me to do it?
Oh, here, give it
If you got
to
it in front
Eric.
of you, go ahead, my friend.
All right.
Eric.
Here it is.
Awesome. We're gonna call to order the June 22nd meeting of the regular Police and Fire Pension Board. The first thing up for review is to review and approve the minutes of the February 23 meeting. Do I have a motion on that?
First, motion to.
Second?
I have a first and a second. All those in favor?
Aye.
Aye.
All right, the motion carries. Anybody against? Okay, very good. The, second item on the agenda is to review and approve the normal retirement for Police Lieutenant James Perez, effective July 14th, 2022. Do I have a motion on that?
I'll move it.
Thank you.
Second.
Thank you. Shill, do you wanna walk us through this retirement?
There is nothing to really, it's a normal retirement. And, there's nothing other than that to say.
Very good. That being said, any questions on the motion? Hearing none?
No.
All those in favor, aye?
Aye.
Aye.
Anyone against? Then the motion carries. The normal retirement for Police Lieutenant James Perez has been awarded. Next item on the agenda is to review and approve the normal retirement for Police Officer Gregory Carroll, effective July 22, 2022. Have a motion on that, please?
So moved.
Seconded.
Second.
Thank you. Cheryl?
Again, another normal retirement.
Okay. Any questions? All those in favor, aye?
Aye.
Aye. Anyone against? Hearing none, the motion moves. That approved the normal retirement for Police Officer Greg Carroll, and I have a motion for adjournment, please. Seconded.
Second.
All those in favor, aye?
Aye.
Aye.
All right.
Turned.
Done.
Well
Like
done.
Just like that.
Thanks, guys. Way to pull that off.
That was
easy.
Way to go.
Look at that.
All right. So then let's roll.
Okay, we're gonna start, so you wanna say we're gonna start?
Yep, I'm gonna convene the Joint Retirement Investment Board meeting, a regular meeting. Tonight is Wednesday, June
Can I just say real
22nd,
quick?
7 p.m.
Sorry.
Yep.
I didn't, I checked the website, and there was no police and fire listed as occurring today. There were months listed, and June wasn't one of them.
It's posted.
Maybe I'm looking in the wrong place.
So, yeah, the police and fire's on a different group
It's on a
than the
different,
joint,
yeah.
and if you're looking at the pull-down
They
menu,
each
that
have
may
a
be the
different
reason
group,
why.
yeah.
Okay,
Yeah, it's,
alrighty.
All righty, well,
Sorry about that.
that's okay. That's all right. All right. Shall we convene?
Convene.
7:03, do we have the recording on?
Recording's on.
All right, guys, thank you. All right, first item is to hear, consider, and approve the minutes of the regular meeting of the May 25th, 2022 J-RIBS meeting. Have I asked anyone? Bruce?
I, approve.
Move to approve the minutes. We have a second. Eric Calaver's a second. Right, all in favor? Say aye.
Aye.
Gentlemen on the phone? Jim, Nick?
You guys approve? Hello,
Yes, I
Jim and Nick? Okay.
Can you hear me?
All right, good. All right, do we have any abstain? Any opposed? No. Motion carries. Thank you. All right, let's, with that, next up is the performance review we have with our investment manager, Mesereau. Mark and Courtney, thank you for joining us. We had you here about a year ago, and we're delighted you were able to join us again this year. Thanks to Brian Binkley for kind of providing the quarterbacking on this.
My pleasure.
Would you like to, anything you want to say beforehand, or do we?
Nothing in particular, but it's good to have them both back again, to provide a good review. It was helpful last year to the JRIB, and, I'll turn it directly over to Courtney and Mark. Thanks for joining.
Well, great. Well, thank you all. It's a real pleasure to be with you tonight. We appreciate it. I am going to pull up my screen here, and I think you have the materials, but we'll pull them up here as well to make sure you can see them and follow along. So it's nice to be with you. I think you all know who we are. I'm Courtney Haynes. I'm a senior managing director, and I'm responsible for investor and consultant relations at Mesereau Private Equity. And I'm joined here today by Mark Sachs. Mark is our CEO and the head of the private equity business. So we're really delighted to have the opportunity to share a portfolio review and performance update with you. We've got a nice update to share. And I just would like to first say thank you for your support. We're proud to work on behalf of the town of Fairfield, and we appreciate your commitments to two of our private equity funds, Fund 6 and Fund 7A. So what I'll do is I'll just give you a quick update on the firm, the organization, team, and performance, and then I'll turn it over to Mark to really do a deep dive on the portfolios where you have exposure. So real briefly, not a lot has changed in terms of our business. We are a mid-sized kind of boutique fund-to-fund manager. We have $7 billion in AUM. That's across our private equity fund active funds where you have exposure, our co-investment funds, and our custom accounts that we work on behalf of institutional clients for the most part. I hope that you've come to know us as a premier provider of private equity solutions for you, and that we've generated a long history of consistent outperformance across our strategies. We really stick to our knitting. We raise moderately sized funds. It allows us to be highly selective in terms of our portfolio construction, and I think the results we'll show you here today, but I think that's been the key to us generating outperformance for our clients. Our team slide is here on slide 5. Again, Mark is the leader of our business, so I won't belabor turning this over to him, but I would just like to point out we are always thoughtfully and strategically adding to our team ahead of assets, and we have made a few hires since we've last been here with you all. One of Mesero's missions is focused around DEI, and so we really have pioneered Mesero. Our parent company has pioneered some DEI efforts, and with Mark's support, this has become a key business where we've embraced that. So you'll see at the bottom or kind of upper left-hand side of this slide, since we've last spoke to you, we have hired Anthony Darris, Emmanuel Williamson, and we have a rotational analyst in Erica Diaz, who have all joined the investment team. I just call your attention to it, one, because we think that you'll see real depth and breadth of experience here, but also a commitment to really providing opportunities for folks interested in this asset class that may not otherwise have that opportunity. My team is here to be a resource to you all. So if we can ever provide updates, answer questions, we should be, I hope, viewed as an extension of your team. We have a great accounting and operational group. We have a nice partner on the legal and compliance side. And really, our mission goals are to generate outperformance and to deliver very high quality client service. Just so you know what we've been up to, we are currently approaching the final closes for our current fund to fund, which is Fund 8A. We've reached the hard cap of $900 million. And our current co-investment fund, Fund 8B, the cap for this fund is $500 million. We have $1.32 million left to go before we reach the cap, but we are diligently to have final closes that will be right around the end of this month. So you understand our plans. We will launch similar size and strategies for our successor programs later this year, the second half of this year, with targeted first closes in the first quarter of 2023, and will be open all of that year into 2024. The only other thing I would note, you have come to experience some of our secondary investments in the fund-to-fund program, kind of a part of investor and consultant demand. We may launch an extension where we raise a small secondary fund with an emphasis on GP-led investments. We're kind of in the initial stages of discussions right now with potential anchor investors, but just so you're aware of our plans, I would never want anything to come as a surprise to you. Probably later this year, we'll launch a $250 million secondary focused fund. Again, we'd love your consideration of any of these funds, but I just wanted you to also be aware of our plans here. So the next two slides I think are really important. This is our performance. So slide 7 here, this is the fund-to-fund performance. As you know, you made a $15 million commitment to Fund 6 and a $4 million commitment to Fund 7A. We're proud of this performance. We have generated exceptional absolute returns for our investors. What we are showing you here is 3/31 performance. Unfortunately, the benchmarks are still as of 12/31. So the dark blue bar is what we've generated. The light blue bar is lagging. But any way you slice it, I think we're really proud of the 25, 27% net IRRs. And for us, it's very, very important to deliver strong TVPI multiples, which are total value to paid in capital multiples, generating a net 2 times or 2.5 plus times return for our investors is something that we're proud of. We've done this in a very risk mitigated way. You can see the loss rates on invested capital well below 1%, 0.6%. And I think that's a testament to our really disciplined investment process and careful manager selection. The only thing I would note here, this is just primary exposure with a bit of opportunistic secondaries. So I wanted to show you on slide 8 here our core co-investment track record. And again, I think on the key metrics, looking at portfolio returns of over 30% and a multiple on invested capital for the total portfolio of 2.4 times, but maybe more importantly, a realized return multiple on invested capital of 3.1 times. So I just wanted to give the overview here. Let me turn it over to Mark now to really dive into the Town of Fairfield performance summary and portfolio update.
Thanks, Courtney, and good evening, everyone. It's great to see you all again, once again, and thanks for inviting us back this year. Hope everyone is healthy and well, and it's nice to see you again. I'm going to pick up with a summary of the Town of Fairfield's investment commitments to 2 of our private equity partnership funds. And I also want to say thank you for your support and your partnership with us going back now almost 10 years. So let's start at the top of page 10. Just to remind you, the Town of Fairfield committed $15 million to our 2013 private equity partnership fund. We've drawn almost all of the commitment. We've drawn $13.2 million. This fund is performing exceptionally well, deep first quartile, and we've actually distributed more than we've drawn now in cash. So we've distributed $14.5 million. Remaining value is 21.7. So against a cost basis for you of $13.2 million, the total value, including distributions and remaining value, is $27,715,000, which computes to just under a 25% net IRR over these 9 years, and a net total value on drawn capital to 2.7 times. So I'll go into a little more detail, but we're really delighted with not only the IRR, which is excellent, but the multiple, which well in excess of our target of 2 times, and actually is approaching a 3 times multiple. Subsequent to Fund 6, you continued to support our successor fund, which is Partnership Fund 7A. That was a $4 million commitment in 2017. That's a younger fund. It's not fully drawn. It's about 75% or so drawn. We've drawn $2.68 million. Distributions are just beginning to start now, and I expect as the early deals become mature and we begin to sell, to liquidate, to take them public, and so forth, distributions should begin in a more fulsome way, probably starting in 2023. The IRR is just under 27%, 26.7% over these last 5 years, and the TVPI is at 1.8. And I'll remind you that this is an early fund, really in the early part of its life, and we're highly confident that as this fund matures, it should exceed 2 times net multiple on this diversified private equity fund of fund. All right, so that's let me give you the total summary. So in total, you committed $19 million. We've drawn just under $16 million. We've distributed $14.6 million, and the remaining NAV is $26.3 million. So again, against distributions of just under $16 million, we've produced value of around $41 million for a 24.9% net IRR on a combined basis, and a 2.6 times multiple on capital. So we're pleased, and we expect that this performance will continue to be strong going forward. All right, so let's just take a little, yes, ma'am.
Can I just interrupt? I want to make sure that we kind of, you had mentioned something that piqued my interest, right, of suggesting that distributions, which had begun, may not begin again in earnest until 2023. I'm assuming that's because of how you're interpreting kind of present market conditions, and I'm hoping that you can address that over the course of the presentation, please.
Yes, so there's several very good questions embedded in there. So first, the distributions have been very small because it's a young fund, and we generally draw about 72% or so of capital from you, and then the rest of the unfunded commitment is funded through distributions. And we just had another call that is due, I believe, next Monday, that takes us up to about 72% capital drawn. And normally, once we get to around 75% of capital, that's really the last time we will draw capital from you. And normally, and then this is 20 years of experience, I can't guarantee you that'll happen here, but normally then the last 25% or so of unfunded commitments, in other words, as we draw down capital for that last component, is normally not funded out of capital calls, it's normally funded out of distributions. So that's why the distributions probably will not begin until next year, because we're going to turn those distributions around and use it to fund future capital calls. It's very efficient. It's a way to really enhance both the multiple on invested capital and net IRR. And that's, the plan. But I can't promise you that that'll happen in this case. That's been our experience in, all of our funds over the last 20 years or so. To your other question, though, about the volatility, let's call it, in the public markets, let me start by saying that Fund 6 is fairly well baked at this point. There is a lot of value left, call it 21.7 million, but we've already returned more than cost. This portfolio is an older, more mature portfolio that's well diversified in terms of industry. And, we don't expect that there'll be, I can't predict the future, but assuming that we've now that the tech market has repriced downward, call it 35% or so in the last 6 or 8 weeks, there may be some minor impact on the portfolio, but we expect this portfolio will continue to generate, very strong returns. Fund 7A is much younger. There's been very little in the way of exits or liquidity. In fact, you can see we've drawn 2.7 million, and there's been value that's been building. It's up to 4.6 million. But still, there's a lot of investments that have not yet been made. Again, about the last 30% or so, 28% of the portfolio. The good news on that point is we'll be investing going forward, or the underlying managers will, particularly in tech, at lower valuations than we saw over the last few years. But there could be more of an impact on the current value or the remaining value here for Fund 7A. There could be I still think it's going to be minor. I don't think it'll be of great significance. There really was no change in valuations in March. The June 30 valuations is where we would pick up some of the, chaos or volatility we're seeing in the public markets. Those valuations will not be out until probably the end of August. So
Mark, if I could interject a question at that point, please?
Sure.
It's relevant to what you just said. Could you just, at a high level, describe what the evaluation methodology or process is? So do the underlying managers value the positions, or do you ever override them? Just in an overview kind of way, could you just talk about how you come up with valuations, how you report them?
Yes, it's a great question. So we almost, in every case, almost without exception, use the underlying private equity managers' valuations for our own. there's only been a few examples where, we may have gotten a, December 31 valuation in March because it's an annual and it takes several months. And to the extent that there are a few large public positions that have, dropped significantly, we, in a few cases over the years, have marked down some of those positions just to be conservative. But, the vast majority of your investments in 6 and 7A are sitting in privately held companies. These companies are valued every quarter. To the extent there are public companies, it's a very small percentage. And, generally, I don't know that there are really many, if at all, in these portfolios. It's a small part because generally the managers, when these companies go public, they very quickly look to distribute it out in the form of cash. So we just take the general partners valuations here in these fund-to-fund portfolios in virtually every single case.
Thank you.
Mark, follow on to that question.
Yeah.
Doesn't the equity manager get the mark to market on these positions from a third party? They don't do it themselves, do they?
Yes, they do. Remember, these are privately held companies. In most cases, the manager, call it Thoma Bravo or TSG or Hellman and Friedman, most of the capital in these funds are invested in buyouts or change of control transactions. So not all, but most of the companies underlying these portfolios are virtually all of them are private, if not all of them. And most of them are controlled in terms of the majority equity by the managers that we've invested for you. So they control these companies. They are majority owner, and it's up to them to, cautiously and conservatively mark these companies to market. And they usually, do a few things. They could do a discounted cash flow analysis. They might look to take an average of publicly traded comparables, but there really is no perfect market because these are private companies. So it's not like an equity portfolio where, you literally can market second to second. I will say that one of the ways that we become comfortable with managers and invest with them again is we expect them to carry these companies conservatively. And, in almost every case, when the companies are converted from unrealized to actually realized, meaning from being carried in the portfolio on a mark to market versus when they're sold or taken public, the vast majority of the time and the vast majority of our managers, these companies are actually sold or liquidated or realized at valuations generally above where they're being carried. And that's the way we like it. We don't want to be surprised.
That includes across cycles, I assume? I'm hoping?
Yes, that's true. It's exactly right. Across cycles. Now, I can't promise you, look, like Fund 6 has probably got 1,000 underlying companies in it. And now that it's a fully invested, fully committed, mature portfolio. Fund 7A would not be that large because it's newer. There may be a few companies where that may not be the case, but we are very, very focused on making sure, and we are very clear with our managers. We want them to mark these companies to market, but we do not want to be surprised on the exit with values that are below where they're carrying. You can surprise us on the upside if you like. We'd rather be close to where you market, but we do not want them to unrealistically carry them. So that's why I made these comments, and I think that it's possible there might be some modest, and I really mean that sincerely, kind of minor markdowns at June. We think it'll be, really a very minor, if not de minimis impact on the portfolio. We'll know more. It's not even June 30. But we'll know more, by the mid and the end of July. We are talking to all of our managers, and, we're expecting, particularly in some of the tech companies, there might be a minor markdown, but I just think in terms of your portfolios, particularly Fund 6, they're mature, they're diversified, and, most of the damage that's taken place in the public markets have been in tech companies, which is, a significant but not a major part of these funds. So I guess the summary is we're feeling confident, we're not concerned, and, really, one of the keys to, and you asked the right question, you cannot time the private equity markets. When the stock markets are high and interest rates are low, which has been the case until, 6 or 8 weeks ago, it's been a fantastic time to exit. And that's why if you look at 6, you can see we've generated, these excellent returns by selling into strength and into these frothy markets. On the other hand, when valuations are super high, it's a little more challenging to invest. So, our experience has been, my experience has been over, 30 years, the best way to generate top tier private equity performance is to not put the pedal to the metal, but to sort of consistently commit capital year in and year out to the very best managers focused on their areas of real expertise. Don't try and time it. Don't try and pull back or speed up. And over time, I think Courtney just showed you our 20-year returns. We should be able to generate, significant premiums over public markets. And, these last 10 years that you've been with us have been excellent. And we're having a little bit of a blip right now. I can't tell you where the markets will be in 3 months, but I'm very confident that, we've invested here with great managers in solid companies with that are performing well. I mean, that's the other thing. I guess the last thing to say is that, even companies that have been invested, over the last year or two at, what may be higher valuations where those comps are trading today, as we look through the portfolios that we've invested in, there are very, very few, de minimis number of companies that are operationally troubled at this point. They're performing to plan, they're performing very well. But if, the market has repriced permanently here, and if multiples have gone from, 20 to 12, we may have to hold some of these investments for another 18 months or 2 years. So they grow into the, kind of lower multiple environment that we're seeing, particularly in tech. So I hope that answers the question. I hope that gives you a transparent answer, but also gives you some comfort, that we're very confident in these portfolios.
If I might follow up on that. So particularly if we're talking about Fund 7A, and there's still, a third or so of the assets kind of yet to be invested in. Does that give you an opportunity to diversify the fund in a way that is different than you had anticipated before this market period? So, would you de-emphasize venture cap growth equity and then try to look at U.S. buyout, or is that sub-asset level allocation fairly well set?
So that's a great question. Maybe we should go to that. Maybe we should jump ahead, Courtney, to 7A and answer the lady's question. So, all right, so this is 7A. You have a smaller commitment here, $4 million as part of our $646 million fund. So this is fully committed to 27 managers. And if you look down, so we've drawn, well, this says 67%, but there's another 3% call, which I think is due on the 27th or 28th of June. So as of this moment, we're about 70% drawn. But in any event, to your question, if you look down on the lower right, the vast majority of the capital is in buyouts, 45% in the US, 11% effectively in Western Europe. Even the special situations, if you look at that list, Abry, HIG, KPS, Thoma Bravo, Credit, and TSG, these really are late stage cash flow positive buyouts that have a particular industry focus. Abry is media, TSG is consumer branded products, KPS is troubled, broken companies. That's why we call them special, because they're really very focused on a particular sector. But these are not venture capital companies. These are companies that are basically all cash flow positive at the point of entry. If you look at this colored pie chart on the lower right here on 14, I know venture capital and growth says 25%, but about half of that is in what we would consider to be true early stage venture capital. If you look on the left here, Canaan, Lightspeed, NEA, Silversmith actually is growth. So really only about 10 or 12% of the portfolio is in venture. It's performing very, very well. And I guess the short answer to your question is no, actually, we wouldn't change the portfolio construction. There isn't any manager on this page that is suffering or struggling. And actually, the fact that about a third of the portfolio has not yet been invested is very exciting, actually, because we're going to be investing, or these underlying managers are going to be investing over the next, call it, 18 months or 2 years at significantly lower valuations. So we think this is a great opportunity, and I'm pleased that a good third, and you probably know we generally overcommit the funds by 5 or 10% to reinvest, the fees that leach out. So it'll be actually a little bit more than a third, maybe 35% or so. So we think it's a great opportunity. If you look back in the last 20 years, right after the bubble, the tech bubble in 01, that was if you could raise money, which was very hard. 02, 03, these were fabulous vintage years to be investing in private equity because valuations were low, tech markets and stock market had collapsed. Same thing after the great financial crisis in 09. Very hard to raise money, but if you could raise money, it was great to invest in 2010, 11, and 12 because there wasn't a lot of capital sloshing around and valuations were low. So
on that point, Mark, if I could,
yeah.
I'm looking at that chart. I think we're on the same. Well, we were just talking about slide 14.
Yeah.
I see the vintage year 2019 is pretty robust. Did you have an explanation for investing in what might have been seen by the uneducated me as an expensive time to be investing? I'm just curious what was going on that made 2019 such an attractive time to be for your managers to be investing.
Yeah, the short answer is we construct these partnership portfolios to invest over 4 or 5 vintage years to provide exposure for our investors in the very best funds, and they generally come back every 4 or 5 years. And we want to capture a strip of the very, very best funds in the world that come back over a normal 4 to 5 year cycle. And it's lumpy. I'd like to tell you we can do, a 30% a year, over 3 1/3 years. It just doesn't work that way. So there was no intent to put 41% of the portfolio to work in 2019. But I can tell you, every one of the managers, I'm scanning their names now, every one of these managers, represent top tier private equity firms. They're dominant in their space, in their sector, and they're all doing very well. And that includes the funds that we did in 2019. So that's the key, actually, is there are, virtually no companies, and 7A, I have to tell you, is like I hate to say this because I may be wrong. It's not, I'll knock on wood and say 7A is like a perfect portfolio. Everything has come out of the box quickly. We've gotten a lot of early great liquidity. I mean, that's why we've got a 27% IRR, and a stronger 1 and 3 year because we invested in great deals and great funds. Everything's kind of been clicking, and there's really no soft spots in the portfolio. And actually, it's a good thing to meter the capital out. We not only want manager diversification, and sector diversification and sub-asset class, as we call it. We also want vintage year diversification, and you've got that. And, this fund, has 4 vintage years of excellent managers, and, we're really not concerned. But good question.
What would be a special situation example? Is it like restructuring, like a distressed asset
Right.
class, or?
So you know what? Let me see, what's on the next page here?
We've got some drivers here, Mark, or we can,
Yeah, so let me, let's go back. I'll tell you what, let me answer that question. Let's go back to 6, because I do want to
Yeah.
give you some of the drivers in the portfolio. But special situations, as I said before, really is our nomenclature for managers that are highly focused in a particular sector or silo. And they've really become, we think, the best in class and the best in the industry. So for example, Partners, where we've invested both in their mezzanine fund called, or their senior equity fund, which is their mezzanine fund, and senior securities called ASF. Abry is a Boston-based firm with a West Coast office that we really think is the most successful private equity firm in the industry, focused on media companies, communication companies, content providers for radio, TV, billboards, social media. And they're just a super focused, excellent firm. And that's why we call them special, because they're not diversified. They're not going to do tech. They're not going to do retail. They're not going to do restaurants. They're not going to do troubled company. They're certainly not going to do, what some of these other managers do. TSG Consumer Partners, just for something completely different, is a San Francisco-based manager that is, in our view, the best performing manager in the industry, focused on consumer branded products. And so they have, invested in some of the most iconic brands, including Famous Amos cookies, Smart Balance, which we co-invested with them years ago, generated almost 10 times capital, vitamin water. And in this portfolio, maybe we'll talk about this since you're invested in this. So here is TSG Fund 7A, a $2 billion 2015 fund. And Fund 6 really overweighted their commitment because we had tremendous confidence in TSG. And out of this $650, $700 million fund with the overcommit, we committed $49 million to TSG Fund 7A. At December 31, our commitment is generating a 30% net IRR, which is a deep first quartile, generating 3 times capital, which is excellent. Some of the drivers include Dutch Bros, which is a co-investment we did with them, which is the largest privately held drive-through coffee chain. It's based in Oregon. It's public right now, and it's trading at around 9 or 10 times capital. We also have an investment in Duckhorn, which is a wine producer based in Northern California. That's also public and is trading at around 3 or 4 times capital. So those are 2 of the underlying drivers. So TSG is a great example of a spectacular manager focused on multi-unit consumer branded products. As long as I'm here, may I tell you about 2 of the other portfolio drivers. You also have exposure to Lightspeed, which is an excellent early stage technology venture capital fund. Fund 6 invested $12 million in Lightspeed. It's a 2016 fund. It's now fully drawn. It's generating just over a 38% net IRR and a 3.5 times multiple on invested capital. And then The last portfolio driver I'll share with you is a late-stage venture capital fund, the firm we've backed for many years, Meritech, also, of course, in Silicon Valley. And Fund 6 committed $17.2 million to Meritech's fifth fund, which is a 2014 fund. And believe it or not, that fund is generating a 57%, almost 8-year net IRR, which is 8.4 times capital. It's already distributed almost 4 times drawn capital. And there are some massive home runs, and one or two that I'll share with you is Roblox, if you have heard of it. It's an online gaming platform, which has been partially realized and went public about a year ago, and that is producing 59 times capital. That's, that would be a home run. That'd be a grand slam. Another one is Datadog, which is another technology company for IT infrastructure, and that's generating over 40 times capital. So 3 different strategies, 3 different managers, all performing with excellence, and hope that gives you a little bit of a sense what's in the portfolio. Why don't we,
You tell me, Mark, and I will follow where you would like to go.
Go ahead, Courtney. So if there are no questions, Courtney, are you?
No, feel
All right.
free. I just wanted to get you the right slides.
Right. Okay, so this is 7A. We're back to 7A. And as we talked about, maybe just backing up one slide to remind you, you have a $4 million commitment to this 2017 fund. It's drawn, including the current call, about 72%. We expect we'll fund the rest through distributions. It's generating just under a 27% net IRR. Performance has been terrific. We're not concerned about any of the deals or any of the managers. And here are a few portfolio drivers to 7A. Next page, please, Courtney. All right, so on the left, this is an example of a new manager that was formed by 3 very experienced guys who left their prior firm, Bain Capital, and several others to form Silversmith about 8 or 9 years ago. We jumped all over it. We were in the first Silversmith fund, which is generating spectacular returns. And here in 7A, we invested $20 million in their second fund. They're really investing in growth companies where they think there's an opportunity for growing end use markets. There often is a healthcare or technology aspect to the companies, but the key is they're looking for rapidly growing companies. So Silversmith Fund 2 is now fully drawn. It's generating just under 3 times capital and a 56% net IRR. And we're delighted with the performance of this fund. This has really added a lot of value to, and it's kind of right up the road from you folks in Boston. Here's a second key portfolio driver, Advent, which is one of the dominant private equity firms in Western Europe. Fund 7A invested $25 million in their 9th fund, which was formed about 3 years ago. They're investing in cash flow positive buyouts generally in Western Europe. This fund is about 70% drawn, has had some terrific early exits, and is generating a 70% net IRR at December and a little over 2 times capital. So again, this is European exposure primarily, and performing really with excellence. And then finally, on the right, one of my favorite funds, a San Diego-based firm called JMI. They're also doing a growth equity. They are similar in a way to Silversmith, in that they're buying rapidly growing companies. And we invested $25 million out of 7A into JMI, which is about 4 years old now, and is fully drawn, generating a 41% net IRR. So there's a sort of a snapshot of some of the underlying funds and companies that are in the portfolio of 7A and Fund 6. So,
Quick question, Mark, if I may. I'm looking at Silversmith and JMI. I'm wondering, and they're both relatively small, so maybe that's the answer, but how do you keep your managers from competing with each other for the same transactions?
yeah, it's a great question.
How do you think about that?
Yeah, we do think about that. Let me also say that I'm glad you noticed that these are small managers. You know, we underwrite every manager, no matter how many times we've backed them each time. They have to actually hit a very high bar, and we do drop managers if they get too large, if we think they're no longer able to generate excellent returns, if key people have left, if they're really unable to deploy the capital they want to raise, and we are looking to bring in kind of fresh blood, these smaller, younger firms. JMI is a little older, but Silversmith and JMI are both examples of smaller funds that we've brought into the portfolio. Silversmith about 7 years ago, JMI about 8 years ago, really to bring hungry, talented, smaller private equity firms where we think there's an opportunity for exceptional performance. So that was my preamble. We're very careful about making sure our managers don't compete with each other. It does happen once in a while. It's very rare. And once in a while, one of our managers will sell a company to another manager's, but that also is not common, but it does happen once in a while. But I don't believe Silversmith and JMI have really ever competed for a transaction. JMI is much more kind of software focused. Silversmith is really kind of more focused on healthcare, information technology, and services.
Thank you.
Oh, so I guess we're going to stand by for questions. Oh, I guess the last thing we should say is, we are we've just finished raising our 8th fund. We want you to know what we're doing. You're in 6 and 7. We did raise, thanks, Courtney. We did raise a successor partnership fund, oversubscribed at $900 million. We've now committed about 2/3 of that fund, and we're getting ready to launch Fund 9, which will be at the end of the year. What's interesting now about our partnership funds, which we started with 8A, is that it's not a pure partnership fund anymore, kind of based on client demand. Fund 8A, and we know that the next fund, which we're going to call 9A, it'll be 70% newly formed primary funds, 15% in secondaries, and 15% in co-investments. So I just wanted to share with you that our flagship funds are themselves diversified into secondaries, primaries, and co-investments. And 8A is also mostly committed at this point. We'll probably be finishing that fund in the next 9 months. And we're going to launch a successor fund, which we will cleverly call 9B, also sometime after Labor Day. So if there's interest, we'd be delighted to send you the materials. And then finally, at the bottom of this page, we just want you to know, that, the secondary market has been evolving and morphing, and the sort of traditional secondaries where, you might have a $20 million investment in KKR, you're tired of it, you want to sell it and redeploy capital into new funds, and, someone like us comes along and buys an interest in a fund that might have 25 investments. So though that is still part of the secondary market, the larger, more interesting part are these single asset deals where, KKR might have one company in their portfolio that we think has, the opportunity to really have a steep growth opportunity. And so they might lift that company out, recapitalize it in a special purpose vehicle, bring, outside investors like Mesirow in, and really kind of reset the clock for another 4 to 5 year investment period. Those single asset deals are very, very interesting. They really are co-investments, except they're kind of curated. They've been in these portfolios for 4 or 5 years. And so we've really had a lot more opportunity than we have capital, which I guess is a good thing, but we are leaving a lot of opportunity on the table, which is not so good. So we've been in discussion with some investors that have interest in seeding and anchoring a really first ever fully dedicated secondary fund. And we are probably going to do that, and that'll probably be later this year. So 3 new funds coming out from Mesero, a flagship fund that's a mix of partnership, secondaries, co-investments, another pure co-investment fund, and then a secondary fund. So I wanted to give you the brief commercial so you knew what was coming, and if it was of interest, of course, we're happy to talk to you about it.
Very much appreciate that. This has been a great update. Are there any final questions? I want to be careful of everyone's time this evening. Any other questions? Nope. Thank you, Mark and Courtney, for joining us. You've given us a lot to think about, and I thank you for the really comprehensive review. And thank you for going off script and allowing us to just ask you questions. We really do appreciate that.
Those were great questions. Thank you for your time, and everyone stay well.
Thank you all.
Thank you.
Thanks, everybody.
Thank you.
Thank you.
All right, that was great.
Should I jump in?
We'll know what's going to happen with the June results.
Yeah, maybe I'll make a couple of comments related to that. I just happened to have a call with HarborVest today, and they were just kind of giving an overview of what's happening on the private equity side. Just a little bit on the fund, but more on the private equity side. And we're going to break it out of buckets, like what's happening with liquidity, what's happening with investing, fundraising, and performance. And so from a liquidity standpoint, they've seen the market tighten up quite a bit. Like liquidity is kind of really dried up. And they didn't name names, but they've talked about some prominent endowments and foundations that, kind of overweight the privates and may be looking to, try to reduce some of it. Kind of heard that from Lexington last month. But that was a quick update on liquidity. It's really tightened up pretty quickly. And that's usually the first thing I see. From an investing standpoint, it just creates a lot more uncertainty. Like, maybe you won't commit to a new fund that's just starting out, like if you're a fund of funds like Mesero or HarborVest. So activity has slowed there as well. Fundraising, they haven't seen slow year to date, but expect fundraising to slow in the second half of this year. But so far this year, it hasn't really lagged. And then from a performance standpoint, usually lags the public markets. And so the first quarter was generally good. They expect the second quarter to be somewhat flat, and then, maybe expect to see some pullback in the third or fourth quarter. But that was coming off of, what one of the senior managing directors who you met virtually about a year or so ago said, like 2020 was one of the strongest years that he's seen in the private equity industry, like across all rows as far as liquidity, investing, fundraising. So it's just a matter of giving some back here in 2022, not unlike the public markets, right? Like, I looked at where we were, not to kind of throw salt on an open wound, but like May of last year, the pension was up over 22% on a fiscal year-to-date basis. Fiscal year-to-date, we're down about 4.5%. So it's, trees can't grow to the sky. It's kind of, it's lumpy.
But Bruce brought out the best question. Well, it's the private markets. You're not marking any market. There's no market to market too, right?
Right.
You're just
Any sorts of investments in there, they have to have a third-party market, mark to that.
Yeah.
Otherwise,
You're making up your numbers.
And then, what disturbed me is he tries to point out items like Roblox and Dutch Brothers, which are down 60 and 80% from where they were.
Mm-hmm.
I mean, if they haven't liquidated all these things, there's going to be some serious devaluation.
Yeah. And that's the key word, evaluation. So, that's what HarborVest is talking about is that, what the immediate impact you see is that these general partners have to, reduce the valuations of what they had for these companies. And so that's what you'll probably see in the back half of of this year. At least that's their expectation. On the positive side, and it kind of echoes what, Mark was saying, is that historically, you know, they're not making any promises either, but historically, this has been a good time to start investing in private equity. You know, you're making your commitments last year, this year, but that doesn't mean the investments are getting made. They're, you know, they'll be throughout this year, next year. So you're investing into a down market, and that's been some of the best valuations that they've seen after, you know, 10 years after.
Right.
So these are generally been good vintages to start going in. So not that we're timing it either, right? We started last year. We'll, I think in the next meeting, maybe refresh that cash flow model that we showed last year, and, you know, see how that might have to adjust. So.
Well, we might just be very fortunate and have dodged some difficulties in the spacing out of our private equity.
Right.
In 13, 17, then we didn't do anything, and then we committed the end of last year, which hasn't been drawn down.
Right.
Right, so those investments haven't been made, who might be the beneficiary of far superior valuations over time.
Yes, exactly.
But hopefully they're not wading into the markets right now.
Exactly right.
I know, it seems like no man's land.
Right. I mean, as far as the Harbor Vest Fund, you know, only 0.5% of the capital was called. Like 2.5%, like 2% was been funded, but 11% has been committed. So meaning you committed to a general partner like Thoma Bravo, but Thoma Bravo hasn't called the money yet, but you've committed to their fund. So I think there's been more activity than what it's shown as far as called capital. And then speaking on those 2 points, maybe it's worth going to the presentation. I'll skip the usual preamble, like the markets, and I don't know if you're able to bring up the presentation, or I'll reference page 8. But as far as cash flows related to private equity, so Harbor Vest made a second call, and so we funded that on June 17th.
Oh.
That was $300,000, and then we just raised cash just on Monday to fund the capital call for Mesereau's 7, you know, what they call Fund 7, and that's $120K. That'll be on June 27th. That money's being called. So if looking just on a year-to-date basis, we've had just slightly more than 1 million called from the existing private equity partners, but we've gotten over 2 million in distributions. Yeah. So on page 8, looking at the allocations, you know, depends how you want to look at the target. I mean, we're slightly above the old 5% target. I think that's a little bit of a denominator effect of public equity and public fixed income coming down, and then the private equity valuations not being drawn down. So that's just a little bit on the cash flow for the pension on page 8 and where the current allocations are. And then I mentioned on a fiscal year-to-date basis, at the top of page 8, you see that fiscal year-to-date down 4.4%, but slightly better than the composite benchmark, and that's really from the private holdings that, you know, we don't have the full marks yet. So second quarter update, I think we'll get more insight into the performance. Yeah, I mean, May itself wasn't a bad month, and the markets were pretty muted, both equity and fixed income. You know, equities are only down, like U.S. equities are only down 0.2%. Bonds were slightly up. That was just 1 month of May. I mean, there's been more pain here in June, which I don't have an update on performance. So that's kind of an update. And on page 12 is just looking at the OPEB plan, and not surprisingly, with a slightly higher risk profile, the OPEB plan is down 6% on a fiscal year-to-date basis. So that was a quick update on private equity, update on cash flows, update on performance. And let me pause for any questions, but then I was going to spend some time more looking at the asset allocation and forward-looking returns. Any other questions that come to mind? I was gonna look at page 18, if you all have that on the screen or hard copy. And there's 2 points, well, maybe 3 points. So we update our capital market forecast, what we expect for all the asset classes as of March. So that's been updated, and so that's reflective in the first column here on page 18. I could share with you if you want, Bruce, if yours is small, but looking at just the current allocation, the 30-year projection for the pension plan is for a return of I'm gonna round to 6.5%. Right, that compares to the discount rate that the town has of 6.9. To the right in the graph, we provide the distribution of returns, because I just quoted you the median, but that 6.9% would fall within that 25th to 75th percentile distribution, to kind of give you a sense. And so that'll be a conversation with the actuary. I think they're joining next month?
Next month.
So wanted to give that in light of the actuary coming next month. And then I had 2 scenarios to the right-hand side. And the first was looking at the similar, same allocation as far as between equities and fixed income of a 60-40, but a slight, shifting some of that public fixed income to investment-grade credit. I'm going to forward to page 25. So historically, investing in investment-grade credit has given a return premium over treasuries, just like equities have a return premium over fixed income. The last few years, if I'm looking at the top left chart on this page, is that yields or spreads over treasuries were at all-time tights, just because there was just a dramatic search for yield. So moving into credit really wasn't that prudent, given how tight spreads were. So what the chart is kind of showing you here is that spreads have started to widen here in 2022, but it's really bringing us back to kind of like a long-term historical average. Nowhere you see the spikes during the recessions, 2020, a little bit in the taper tantrum in 2015, and then it goes back to 2008. So credit is not overwhelmingly like, a buy or anything, even speaking to our active fixed income managers, but to give you a sense, it's kind of back to norms. So now I'm going to flip back to page 8. So if we're to take, so what would that do to the expected returns for the
Brian,
pension?
if I could interrupt, sorry.
Yeah.
So this is dated in March, so I assume spreads have widened, credit spreads have widened since then.
They've continued to widen since March. We just haven't updated, kind of have a quarterly cycle, but yes, the spreads have continued to widen, but they still haven't blown.
Stuff dramatic.
We haven't seen the stress in the system yet, right?
Got it. But it feels like it's kind of coming, doesn't it?
I mean, yes, there's just more and more talk of recession, right? From, whether it's from the Fed or it's from companies, it's more of, I don't think anyone's predicting recession in 2022, but higher likelihood that it's coming, right? So speaking to page 18 is, so we have a 25% allocation to U.S. fixed income. I just said, okay, if we close to split it in half, and it's not quite, and you kept 15% in U.S. Ag, and you took 10% and put it into credit, whether it's intermediate or short term, what happens? And we get a small lift in the expected return, but really it's still kind of muted. So the expected return at the median only goes from 6.49 to that 6.52%. So really not that dramatic. So just as an aside, is like, well, what if we were to increase risk as it relates to public equities? That would be in equal portions of U.S. and international. So if we went to a 65% profile of equities, that's, again, U.S., international, and that's looking at private equity as well. So that expected return jumps a bit more dramatic, so 6.64% at the median. So I think from an expected return profile, the more benefit or bigger bang from increasing the risk profile to equities than to corporate credit.
So still, though, you have to get through in the equity markets, the washout still you have to deal with is, while the multiples have contracted, the earnings haven't been brought down.
Correct.
You need the earnings to be brought down to be reset. You don't get your next kind of bite at that apple until the June 30 results, which then you'll see in mid-August, and
Right.
then you might have to go one more time. So we'd probably be looking to September, we would have a sense. The markets always discount,
Right,
right?
market's
So,
always forward-looking, market's
know,
always trying to,
So,
down over 20%,
but
we're,
it's very hard to think about jumping into doing something like this ahead of that first wave of earnings revisions. Right?
Right.
Or they take a little while.
right. And just as a reminder, it's not in this deck, but, coming into this year, equity valuations were not quite where we were from the dot-com era, but pretty close.
Yeah.
So valuations, just like spreads, were just at
Right.
kind of extreme levels again. And
Right.
so we've seen that come out. But it's a consideration in light of the discount rate, right? I mean, those are the two layers. We can continue to bring down the discount rate, or we could slightly increase the risk profile. And keeping in mind that on the OPEB plan, we're at a 70-30 allocation, right? And the allocation to increase in equities wouldn't be unheard of when you look at other public plans here in Fairfield County, or just the broader public market, kind of peer universe.
I mean, I'm an equity person. I'll never argue against equities, but,
Right.
this is an odd a time as I've seen in 30 years. This has the dynamics of of a pull forward of demand, and it has the credit of 94.
What's right out there?
What?
What's right out there? Anything?
Nothing. There's nothing right out
So
there.
it's pretty hard to make commitments, and
Whew.
even though valuations are starting to look reasonable.
Right, right.
Yeah.
I agree with you, Carol. It's just hard for it. But I think also, at some point, you gotta say, okay,
Got to take a bet.
it's time to take a little, start dipping the toes in the water and adding to,
Yeah.
because this is not a trade, this is a long-term deal.
That's right.
Yeah.
That's why we look and,
Right.
we're looking at 30-year assumptions here. That's consistent with the actuary. We could do shorter time periods, 10 years, 20 years, but we really always tie it back to what the actuary is using in your financial statements. That affects how much you have to contribute into the plan or not.
Mhm.
So it's always long-term focus.
Does Vanguard take a position on the CAPE ratio? Do they believe in Schiller's stuff or no?
We do, and I've showed it in previous, and I'll have an update at the next meeting. So, yes, but we have our own adjustment, is what we refer to as a fair value CAPE. And so the CAPE is the cyclically adjusted PE ratio, just looking at over 10 years' time. That's what the CAPE ratio is, instead of just, say, 12 months. And we've come up with a different metric using the CAPE, but adjusting for where interest rates or inflation is. And so what the short story is that in a low interest rate environment like we were in, you would expect people to be willing to pay higher valuations. But even by that measure, our measure, on the slide we usually show, it was outside of our what we considered fair value. The CAPE was way above what we considered fair value. So
Doesn't Warren Buffett have one too? Like the value of the public securities relative to the reported earnings of the public securities?
it sounds familiar, but it's not
Okay.
the tip of my tongue, but yes.
All right.
Yeah, CAPE was high, and CAPE was even outside of what we considered a fair
Fair
value.
value, right.
Mhm.
Okay.
So, that was the main look, since I had talked about credit, and
Yeah.
Carolyn, you had asked, I
Yeah.
wanted to show where spreads were, so March, what impact it would have on expected returns of the portfolio, and then also what it would look like if you had a little bit of equity, yeah. We never take Vanguard or myself, we're not timing the market, just as you said, Bruce, it's a long-term projection, but it could be more attractive, certainly later this year. Who knows, we're officially as of June 17th in bear market, right, which is down 20% over 2 months or longer. I had shown some slides on that last time. We weren't in a bear market, but I was kind of showing the committee what past bear markets, that they happen every so often.
So how quickly would the allocations be able to be moved, right? So, you know, it's June, you know,
Right.
we meet monthly.
Right.
Like, if we were to suggest that we increase the equity allocation, how quickly would that happen?
It could be done within a day, because most of the portfolio is completely liquid. You know, they're in daily valued funds. So all the public equity and public fixed income, you know, for instance, we just raised, you know, we liquidated, you know, $2 million for pension payments. That's just done in a day. I know we're talking a bigger amount, but no problems. Those are very liquid funds. The funds that are in like total stock market. Well,
Today.
yeah, it's the total stock market.
Liquidity wasn't quite there at the end of April.
You asking about private credit or?
No,
No, I was, the question I had a few months ago, the question I had a couple months ago was thinking in a world where rates were rising, but
Right.
inflation looks to be a little more under control, and the public equities being where they were, would it make sense to leg into another layer of fixed income?
Right.
You know, looking at high grade, right, and trying to
Right.
chase a little bit in there. But the markets have totally changed their complexion here on us.
Right.
And so that's why this analysis is pretty helpful.
Right, right, yeah, on page, you know, you don't need to flip there, but on page, like, say, 22 or 23, I included what are those capital market forecasts for all of those asset classes. Maybe the privates are not in there, but all the public asset classes across equity and fixed income, but say for credit, Carolyn, and
Yeah.
the 50 percentile, you know, on a 30-year time frame, we're expecting the ag to be at 3.6%, and intermediate term credit 4.1. So there is a premium,
Right.
but, you know what, it'll have to be a bigger portion of the portfolio to make an impact.
To make an impact. Now, that was interesting, 3 basis points
Right,
is what you get versus,
right.
you know,
Yeah.
buying
And then-
equities in a bear market and thinking real long term.
And keeping in mind your
Yeah.
question, 85% of the portfolio is liquid on a daily
Yeah.
basis, right? And, the broad equity and broad fixed income mandates. It's just the real estate and the private equity where you don't have that liquidity.
Are you finding that your other clients in your group are kind of beginning to move this way yet, or does it seem too soon? Is it,
I haven't seen any yet. There's still been, or I would say it was more, we're coming into the time with public funds of seeing if it makes sense to adjust any discount rates. I would say last year, it seemed like public funds were more aggressive in lowering them. So for instance, like more 25 basis points was the mean for lowering the expected rate of return. And so broadly, I saw that just in data team and with the other public fund clients I've worked with, is that it was more of a, you know, an eighth or a quarter point move down in expected returns. So I don't know how much, you know, I can tell you in another, you know,
yeah,
month
no,
or so.
I'm thinking more about going farther out in the risk spectrum, with their allocations, that,
Yes,
you know,
and-
beginning to leg more into, towards buying back equities.
That I haven't seen from
Yeah,
any of the clients that I've worked with, yeah, of like, you know, increasing risk yet. I'm just trying to do a quick mental scan,
Yeah.
But it's starting to become more attractive.
well, it will become a little bit unavoidable, right? It's just a matter of
Right,
when.
right,
No one knows when the bottom is, and then, you know,
yeah,
and the timing, you know, the returns are, when it does go shift up, it goes quickly.
correct, it does, well,
Not
yeah,
gonna necessarily be in a long bear market for extended time.
And we
Right.
haven't had a capitulation day, or a capitulation moment. We had a little panic last week, but we really haven't had the capitulation that you generally go through to kind of be like, okay.
But the quote I heard today is, you know, the first half of this year is shaping up to be the worst first 6 months since the Nixon administration, right? So you probably maybe heard that too. So, yeah, maybe there hasn't been days, but it's certainly been bleeding, you know, kind of week after week or month after month, the first 6 months of the year.
Yeah, I mean, the tricky part now is now you're seeing the layoffs relating to housing and mortgages,
Correct.
right? And we lived through that, so what does that do?
Right, the Fed's certainly not done hiking to tame inflation, and the impacts to the economy or housing, you know, always operate on a, I call it, 6 to 9 month lag, so they still don't know the true economic effect of what these interest rate hikes
Yeah.
will be like, and obviously they're pretty dramatic in history, right? A 75 basis point hike hasn't happened since '94.
I don't know, my inclination is I'd rather be a month late to this party than a month early to this party.
Mm-hmm. Yeah.
Because there is so much uncertainty.
How do you hedge yourself in the meantime, while you're sitting there waiting?
Well,
That's the real question.
Historically, with the fixed income portion of your portfolio, but that's what's different about this time. I mean, you know, whether it was '08 or it was 2020, the fixed income markets were up or strong. This time it's not because of the, you know, the rising interest rates. So, you know, that's what's different. So there hasn't been any, refuge in this market. You couldn't even call it cash because then you're, you know, losing, you know, inflation 7-8% and you get zero. So I don't think there's been any place to hide unless you were in commodities, right? Unless you were in, it was that piece.
Yeah, but even then you lost the oil piece of it this week.
Yes, yeah, and I've probably shown that chart in the past that, you know, commodities are, you know, really volatile, and, you know, the last 10 years as of December, it was the worst performing major asset classes. So I would, and just in thinking and answering your question, that was probably been, if you had tips or commodities, that was the only kind of place that's provided some return.
And I think, well, I don't know that we don't have any in there, but some of the, you know, covered writing stuff is helping, provide a hedge for people, because there's volatility has created great premiums and options.
Right.
But you know, that's not part of what we're doing.
No, and I don't want to bring up that. Yeah.
I think we should be buying Similac and selling Bitcoin short.
We know we need Similac. Bitcoin, we don't.
I can't see what Bitcoin is actually for, but yeah, no, I agree.
Yeah.
Good scam.
Yeah, very successful.
Awesome.
So
Eric, thoughts?
those are the high arching comments that I wanted to, you know, communicate for this evening.
How would we compare to international? You know, we always talk about, in the past, the U.S. was overvalued compared to international.
Right.
There's still that spread of, you know, everybody has gone down globally, but.
Yeah, no, that's a good question, and that's what was driving, or still is driving, the longer term higher forecast for international equities versus U.S., but, you know, international markets have been down just as much this year, but that, I think, has been more of what's happening with Russia, because the impact of energy on Europe is more severe than in the U.S. The valuations weren't falling, but I think that was the different dynamic that's causing the stress in Europe, is bigger impact from, you know, the Russia invasion there. So I think the valuation...
Pretty much, but spread quicker over there if there's issues. Yeah. What about going to Asia? How do you see, like, anything good in Asia, like regionally? I know, like... Yeah. So, no, I don't really have any specific comments, or I haven't heard anything specific from the Vanguard team, and that just broadly, because when we have the international market, it's inclusive of emerging markets. So whether it's a 10-year forecast or a 30-year forecast, it's still quite a bit higher for international equities. So speaking to that, on a 30-year basis, 5.5% is our expected return for U.S. equities, 8.1% for international. That's a 10-year, but it would still be similar on a that's a 30, excuse me, 10-year would be similar. But going into more specific countries or regions, we usually don't break it broad. Yeah, we keep it broad. We probably do emerging markets, but not like, you know, China specific, right? Though that our economists were lower than the street as far as economic growth for China, and, you know, we've continued to bring down our GDP estimates, U.S., Europe, and in China. So, and probably a bit faster, so.
Okay, all that exciting, great.
Yeah.
So,
So maybe for the, I was gonna say July, but yeah, it is July.
yeah,
July meeting, I could update the cash flow modeling
Yep.
with respect to their private equity, since it's been a while since we've shown that.
yeah, I think that would be great, and I think we should revisit this, in July for sure.
Right.
About how to address the allocations,
Right.
if we want to make any
Right.
movement.
Oh,
I don't wanna, I'm not inclined
Next
to.
month's okay.
Next month's okay, Chris?
Oh, maybe to some of the questions, we did
We'll get
update,
another sideways month.
I think we do.
Be nice.
Sideways?
Yeah. Sideways would be good.
Sideways would be good, given where we've come from.
I think this is a win.
Sideways.
Yeah. With respect to that, last thing I'll leave you with, on page 21, we did update our chart of other towns within Fairfield County with respect, this is using 2021 data, right? Because that's all we have is from the annual financial statements. But what that slide shows you is the other towns in Fairfield County. We have the discount rate along the x-axis, and on the y-axis, how much they have to return seeking, right? So return seeking could be your equities, it could be high yield, it could be, I say private equity, but that's return seeking assets. And so it's, maybe the only takeaway I have with respect to the other towns in Fairfield County, if you're looking at the discount rate, yes, we're at 7%, we're down 6.9, but Fairfield is at the higher edge of that threshold, just looking at Fairfield County.
Right.
And then the return seeking is kind of close to average, or close to slightly below, but I would say it's about average.
Right, and we don't have the benefit of kind of the historical piece of this, but I might be wrong, maybe you guys can refresh my memory, but most of these towns that have the lower discount rate, did that years ago, right? That wasn't last year.
Yeah, no, we're catching up, I think.
We're slowly catching up to them.
Right.
They moved that
Right,
kind of shortly after the financial crisis.
right.
They did that as a response to the financial crisis, and we stayed
Yeah.
out, so.
I know we've been tracking this for the last 3 or so years, so I could probably put that, turn that around very quickly as far as the last 3 to 4 years, but
No, I mean, that's,
more historical would take time to go through all those financial reports.
it's okay. I think the analysis that you provided of kind of the spread of returns, kind of around our discount rate is more helpful.
Yes, yeah.
That we're still in the band of, I forget what slide that was.
Correct, yeah, just a couple prior.
18.
Right, right.
In this chart, what would be considered a non-return seeking asset?
So, yeah, I guess if we were to label the other piece would be more risk reducing. Like, so return seeking is, think of your equities. The other piece would be your fixed income, your private real estate, that is, usually protecting in down markets. So those, you could even classify, hedge funds in there, right? Because hedge funds are trying to preserve capital. Maybe the hedge funds is a broad term, right? There's so many different types of hedge funds.
Not the ones we know about.
Yeah, but that's how it is.
I'd say it's the founding principle, but.
Right. So we provide that in kind of in the footnote of how we're breaking out return seeking versus risk reducing. But generally speaking, it's your fixed income and your private real estate. And we put private real estate there because usually historically, about half of the return from private real estate has come from the income that they produce, right? So that's more akin to a fixed income investment.
Okay.
Because there's no correlation there either. I mean, it's like, you have Bridgeport and Darien spread on percent of return-seeking assets.
Yeah,
They're very
Darien,
close in discount rate.
yeah, Darien is an interesting one to me, which I haven't dug into, but I've wanted to because I had a similar discussion with another plans that, they're 50-50, right? As far as it's pretty conservative portfolio. But their discount rate is still fairly high. I don't know, maybe they've reduced it since June of last year. but kind of a high discount rate, you know, six
How do
and
you get
3/8 with a 50/50 portfolio, so I don't know.
How would you get there? You know, I mean, how does that make sense?
I would have to look at the specific allocations. I could put it in what our capital market projections and say, well, we think it should be 6, but that doesn't mean that,
Yeah.
you know, they could do it. So, yeah, you could look at the legend, but the size of the bubble is just how big the plan is by assets. We, you know, we put the funded status color coding, kind of less than 90, 90 to 100, and over 100%. Those are kind of fungible. Those, you can have a specific rhyme or reason for those, but.
And of course, the funded status is a little circular because it's connected to the discount rate you're using.
I mean, it's connected to the discount rate, of course, yeah. And that's why when lowering the discount rate, it's usually gradual, a quarter of points, you know.
We're revisiting that next month?
Yeah, next month is our month. As you're looking at this, Brian, anything stick out to you that we should be thinking about as we come into our meeting next month?
Just the comments that you kind of made earlier is, you know, it's still within, that 6.9 is still within the band. I think it's just understanding what the impact that has on financials. It's on the higher side of the current allocation, but within tolerance, I guess is just the best way to put it.
So we look like kind of on the fringes for Fairfield County.
Right.
But do you know nationally how we look?
Yes, yeah, no, glad you brought that up, Tom. So, Hooker and Holcomb just put out a report. They do a nice report for Connecticut. So, you know, on what question, which metric? Because I wrote down a couple. So on a discount rate.
I'm thinking discount rate.
Discount rate, of the 200 municipal plans that they look at, they're at 6.75.
Okay, so we're
Okay.
close.
At a national level, I reference, the organization and CPERS. They're looking at, that, now that includes a lot of big state plans. And they have higher discount rates. So at a national level, it's 7%, you know, as of 2021.
And that's not asset weighted, that's just by pension plan, I assume, equally
Yeah,
weighted?
they have 156 state and municipal plans, but generally speaking, the state plans are more poorly funded and tend to have a higher discount rate. They're probably been more on the 7% side. The municipalities tend to be better funded, generally speaking, than the state plans. So those are the numbers I wrote down, like Hooker and Holcomb for Connecticut is at 6.75, nationally kind of 7%. The Fairfield County data that I showed, at the median, 6 5/8 was the discount rate if you looked at the median there, so hopefully that helps.
So hypothetically, let's say next meeting we decide to go to 6 3/4.
Right.
What are we gonna do to make those changes, and how is that gonna impact the town and contributions, et cetera?
The actuary would have the numbers of how it impacted the town with respect
That's
to
what they'll present.
the contributions.
All right, the contribution will go up.
Yep.
Yeah, yeah.
And then ultimately, we might wanna shade how our equity fixed income balances, or we don't have to.
We don't have to.
You don't have to.
We don't have to.
But you could see, like, you know, that's why I showed what would happen if you increased equities by 5%, and you can see how that impacts it on the upside.
Right. Yeah, so we deliver liability to the town, right? And so the levers that we kind of fall under our purview are the discount rate, the PUD table, mortality
When's the
table.
last time we changed it?
Last year we went from 6.9, we went from 7 to 6.9. With the idea that we would kind of let it sit there for a little bit, and kind of take a very gradual approach.
But things change.
But there's market change.
And also that probably has some unrealized actualized gains too.
And we might have some gains. So this is where,
Mark the market with our actual value and our market value.
yeah,
Yeah, so for instance, last year was a huge banner year above the discount rate, right?
Yep.
This year, you know,
Right.
we're only a couple of weeks away, but, you know, likely very likely we'll be below that.
Right.
So, and then the actuary smooths that.
They do a 5-year smoothing. They do a 5-year smoothing on the numbers, so we really need the actuarial report and numbers to be able to make the decision.
So we're gonna capture a fifth of those earnings.
Right.
Yeah, we only captured a fifth of them, right?
And we do the OPEB valuation once every 2 years, so we haven't even seen it in an OPEB valuation yet.
Okay.
We won't see that till the next
Right.
evaluation.
I glanced over it, but yeah, it is in here on page 20, what's the expected rate of return for the OPEB plan. I'll include it in next month's presentation as well, but just so you know, the OPEB's in this deck as well.
If we're looking at the interest rate, discount rate rather, it seems like it'd be great to have a couple other points of comparison, because if you look at only Fairfield County, I think it dictates a certain answer. If you look at it nationally, as you were saying, or by Connecticut standards, maybe it gives you a different answer from that.
Right,
Yeah.
right.
That we should get from Milliman. That was part of kind of when we chose them out of the RFP process, was they come really with a much deeper and more robust set of comparables and presentation and knowledge for us to draw upon.
Super.
So
Yeah.
that we should have, that will be next month. And we'll kind of weigh it all together. What's nice is now we have Vanguard at the table too. So we're
Right,
not, it's
yeah.
not just the actuary and us. We now have two institutions kind of
Yeah.
providing counsel.
Always say, set it based on the town's circumstances, funded status, and financial, those are just data points to
Yeah.
see what it is, but not a decision, other towns are doing this,
Right.
we should do that. It's
Right.
just,
Right.
you get a sense of Connecticut, Fairfield County, just similar peers.
Is Easton doing exactly what we do, or are we doing exactly what Easton does?
Yeah.
I don't know.
Some of these are very small.
Yeah, Easton's small.
Yeah.
Right?
Yeah,
We ended up at
Easton,
the
yeah.
exact
It's just,
same dot, tiny.
Really
Some
small.
of the unions are in some of the state plans though too,
Right, we don't know what they're,
like the firefighters are in the state MERS plan, so they're not, that's not captured.
Yeah, I mean, we'll really want the benefit of the bigger, the wider aperture as far as, who's doing what, where it's going. But yes, but we can't underestimate the fact that the previous year's results were so strong that actuarially, we're gonna get a benefit, we're gonna get a little
That's right.
tailwind in there. Right? So it's really, it's so hard to just deduce without seeing the numbers.
Right.
And then the town contributions, like from the budget's approved, does it go early on? Is it divided by floors? Is it monthly? Like the cash flow coming in from the town?
In the pension plan, they go in September.
September.
Yep.
It's annual?
Yeah.
Mhm. Needless to say, the Board of Finance will be watching this very closely.
well, I was saying, I mean, we need to dot all our i's and cross our t's so we don't get into that jackpot that we got in last time.
Which is why we
That was
moved the meeting
timing.
to July.
Yeah, that was a timing issue.
It was a timing issue, this is why we're July,
Yeah.
right? And, yeah,
Good.
Timing and
Very, very
communication.
roughly. So in September, the catch-up occurs in one fell swoop.
yeah.
When you say the catch-up,
Or the contribution.
The contribution.
yeah,
The
Well,
contribution.
adjustment goes up because of the.
whatever, it'll be based on whatever the most recent valuation was
Right.
with,
But presumably
if
that
there was a
first month-
change.
I'm thinking about this the right way, could be, the first payment could be large.
So this one, whatever is in the, let's see, so the valuation we've done. Yeah, so the next budget would contain the valuation from, whatever's in the valuation from, that's gonna come out in January, February.
What was the hit when we changed it? What was it, 200,000, 250, I forget what?
No, it was more than that.
500?
I wanna say it was,
500
Okay,
each.
I wanna say 800.
Oh, really? Okay, I knew it was large, I just didn't remember how large.
Yeah.
Yeah, they don't like it.
No, they wouldn't have happy.
They're against big expenditures, you're saying?
Yeah. They really.
Big unforeseen.
Unforeseen, those large contributions, that have to be made are generally not embraced, but they do them,
They have to.
yeah.
Well, they don't have.
Well, they don't have to.
They don't have to.
Well, they want
They
the
don't
credit rating
have
to stay high, and they want their,
This is,
Yeah.
the funded
Still,
status is up to the Board of Finance
It is.
and Selectmen,
Yep.
right?
Yep.
How
I
it
mean-
gets funded and whether it gets funded.
Yeah, and that's the reason why the Fairfield has AAA credit rating, right?
Right, we deliver the liability.
For one reason.
Right, right? We give them the liability, they make their decisions about how
Right.
to,
And to their credit, they've met their obligations, so that's
Yeah.
positive.
right. Right. Yeah, there's gonna be a lot in this number. This is gonna be a complicated one. This is because of the volatility of performance. Right, so let's see what we come out with next month. But next month would be the one, I think it would be really helpful to have annual reports ahead of time. Let
Yeah.
everyone do some pre-reading. If we can ask Milliman if they're, give us a heads up and not just deliver us a set of
Sure.
numbers, so
Yeah.
we can each think about it, reflect on it. Right?
Yep.
Okay. Okay. We move on quickly?
Yeah,
Jared,
yeah.
this is your time. Okay, so quickly kind of move on. We kind of kept it here to, old business, new business, but I was hoping you could,
Yeah. So, one piece was the, pension administration, which got approved by the Board of Selectmen this week, and we're making some modifications. I have, Milliman making some modifications to the contract in our favor. We talked about the 60-month commitment.
yeah.
We've taken that down to 48. And also the assumption in there was for, 26 pay periods worth of pension administration, and we don't do that. Now, in some cases, some of our employees, get paid 52 weeks out of the year. Not all of them, but some of them get paid 52 weeks out of the year. So, they added that in there, but they did not increase the cost to us. So that was something that we negotiated into it. So they're making those changes, and we will have it signed by the end of the week.
All right.
Start on.
Do we have a new head of HR?
We do, yep.
You do?
Yep,
Okay.
yep. Kathleen Simpson, she has a, background, I think she came from, I know she worked in New Haven, and she worked for the state at OPM, and it's been great so far, having her in there, but she, she's got a lot to do. It's a big job, so, but yes. What else? I don't know if you guys want to talk about the, fiduciary insurance?
Yeah, so let's
Do you want to talk about that?
Yeah, so, yes, so our fiduciary insurance comes up for renewal in September, right?
September, yeah.
And
Yep.
Tom had made an inquiry about, can we get a sense of what it is and where it sits, kind of, what the details of the policy is.
Yeah.
And so we're.
So we reached out to them and asked them to provide a couple of different options for increasing the coverage. Right now it's at $5 million. The premium is, about $21,000 on that. And so the next increment would be $8 million. So if we went to $8 million, the premium would go up to about $30,000. And if you wanted to go to 10, it would go to about $37,000.
Is there some kind of
Yes,
ratio that they use for insurance coverage to assets or number of trustees? There's gotta be some kind of comparable that maybe that we can
Yeah.
look at?
Yeah, I took that policy and I sent it over for a competitive view. Just, what market pricing would look like to get a sense of what the market is, but I haven't heard back yet.
Okay, yeah.
And what's the reason for looking at, to increase it? The rationale behind it?
It's just lack of knowledge.
Lack of confidence? I mean, I don't know what.
Lack of knowledge.
Okay, I mean.
What is best practice?
Okay.
What are coverages?
Does it insure,
Right.
Vanguard also as a co-CIO?
I don't know.
I wouldn't think so. What liability does, any one of the directors of the board are sued?
Euclid is
liability
the insurer.
Pardon me?
Euclid Specialty?
I Googled Euclid, and I don't mean to suggest this was a terribly sophisticated examination, but there's not that much information available on them. There's an AM Best rating, which I think is single A, which, AM Best rating is A++, last I looked. So single A is, toward the high end of the range, I think. But it'd be great to have somebody who says, okay, this is a good company, we know of them, maybe have a rating from S&P, Moody's, or Fitch, or, so, I don't know, it just felt like it wasn't that much information. That's point one. Point two was, while the size of the coverage is interesting, it's a claims-made policy, and I don't know what, legally speaking, a claim actually means. So hypothetically, we get subpoenaed, we're deposed, we're represented by town council, maybe not. When do we make our claim? Once we know there's something afoot, or do we wait to pay a bill? I mean, I don't know, and then there's a 12-month extension period that we have to pay for. I mean, I will through it quickly. I'd love to have a lawyer look at this and say, this is market standard, you're covered, you should be happy, or.
Yeah, we may have to find an attorney who specializes in this stuff. And
Maybe
the,
a fiduciary.
you know, the carrier listed on here is Hudson,
Or like, I mean, is it?
Hudson Insurance Company.
I Googled, like I said, I could find very little information on whichever company it was that was named. I thought you said Euclid.
Yeah, Euclid is on the cover of it, Euclid Specialty Managers, and then, it says issuing carriers, Hudson Insurance Company.
Okay, even that I find confusing.
Is this something that the same company we've been with for ages, or is this something new?
As far as I
And would we
Yeah,
have
as
to
far as
put
I
the
know.
RFP if we were gonna look at new insurers?
Understanding the all these implications, probably some sort of reinsurance program, and having an attorney who is an insurance attorney look at it and say, this is what your coverage is. To your question about claims made, obviously you have to be covered at the time a claim is made, and sometimes there's a protection. What if they say, well, it's because one of the directors 5 years ago did it?
Yeah.
Right.
Oh,
Right,
absolutely.
right.
And that's what's really, there's always, there has to be this continuous coverage. It's been my experience with it. But there are attorneys who know this stuff, that's what they do.
Right.
And maybe that's the right thing,
Yeah.
just have them look at it and say, okay, here's what you're covered for legal costs, here's the deductible, not that,
Yep.
obviously, nobody wants to be out of pocket for doing
Volunteer work, yeah.
Right.
But it's a real issue that,
Definitely.
needs to be understood by all of us.
Right. And I'd be curious to know, I guess this is the third point. So the points included, who is Euclid/Hudson, what's claims, how comfortable should we be with a claims paid basis, in this particular type of policy? And then what was it, the third point was, sorry. There's an
Compared,
extension.
no, go ahead. I was just compared it to what our fund is and
Yeah,
how
it'd
much,
be nice to know,
we
what, given the number of people around this table, most of
Amazing.
them are on this pension board, is the coverage limit reasonable? Is it high, low? I mean, I don't think any of us knows. So there are at least three questions there. And I think coverage is, the absolute number of coverage is interesting, but I would say the first two questions are, for me, a bigger deal.
Yeah.
And I think Jim Brown is on the call. Jim, I think I can paraphrase you as saying, I don't want to lose my house over a volunteer position. I believe that was Jim's quote.
That would not be good.
That would not be good.
My wife would not like that. I wouldn't like it either, but my wife would be vocal.
I can reach out to NCFers, we're members, Fairfield Firefighters, we can ask them for any guidance, and maybe the CCM has somebody.
They might, yeah, I can contact CCM.
I bet the town attorney has contact.
He probably does, yep.
I don't think it would be the town attorney, but I think he might know somebody who knows the fiduciary insurance law.
Has the town of Fairfield ever filed a claim with, even during the Madoff times, or was anybody ever, held liable here?
They just took their cut off the top.
Okay, so we don't know.
Yeah. Or, I mean,
So
how
let's
common
find
is it?
out.
I mean, how common is it in
Never
general?
been action brought against us.
Right.
We've always brought the action.
I got you. So, I mean, but yeah, against the town, but even in that time period, was it like, hey, you guys were asleep at the wheel? Your fault?
Oh, and so the fourth question was, if something happens, if we get deposed, if we get subpoenas, does the town attorney represent us? How does that?
I would imagine in that situation, there would be another attorney.
I would assume
who's
we'll
got,
hire our own.
Yeah.
I wouldn't want.
Yeah.
It makes sense, I just think it's worth asking the question.
Yep.
I know when it's come to court cases involving
beneficiaries, it's been risk management. It's hired the law firm.
Okay.
I don't know when it comes to the investment.
Yeah, I think it's a little different.
It's a little different.
Because you could see the town being one of the people, the ones
Not
for
at
us.
all. Thank you. Thank you, Brian.
Thanks, Brian. Thanks, Brian.
Appreciate it. Take care. Have a good night.
Reach out anytime. Thank you.
See you, Brian, thanks.
Well, all right, well, this is to be continued. Let's bring this on. Let's see if we can figure this out. Right?
Yeah.
We have to find the
Yep.
person who has some answers and can give us a perspective, first, I think, and then we can talk about the specifics within it.
The RFP seems like a decision way down the road.
Way down the road, I
May or may
think we
not
just need knowledge first,
Yeah.
right, and understanding and knowledge first.
Yeah.
Okay, so that's a good idea to reach out to, NCFERS and reach out to CCM and let's see if they've tackled it, right, who we should talk with. I don't know, Eric, do you have anybody in Stamford who might have a,
Assume the risk manager, but
do we know?
I don't even
Okay.
know,
We don't
never
have
came
one.
up. Okay.
Okay, all right, so, all right,
Okay.
we'll put our heads together and figure out how we can get smart on this
Okay.
and come to a decision. I didn't have anything else. That was kind of my new business was that. Was there anything else?
We all settled with M&T and everything? I'm sorry.
Yeah,
We
that
all
was my
good?
question. It wasn't here last month. Did you talk about the pension services, payment services, People's and M&T?
Oh, no, yeah, I'll get back on that.
Okay.
I would just think, we're kind of, unearthing a lot of cobwebs and old agreements. We've been kind of doing it for the last couple of years. Something new comes up that like, oh, man, we've been doing that way for years. Let's relook at that. I don't know if there's anything else that we'll come across in the next.
Something tells me when we move the services, the administrative services to Milliman, I think there might be things that come up.
Okay.
Jared, I don't know if you're aware, but we've been working on the COLAs with, People's Bank, and they're sending us back emails that their emails are changing to Williamton Trust as of July 1st. So that's the trust company that's with M&T. I don't know if that's a big difference, but I think you should be aware of that.
And I have an issue about the polls too, so, this is more the police fire side, but I'm gonna have an ask from the board, maybe you guys can support me on this. So every 2 years, these COLA letters go out, to the pensioners and beneficiaries, and typically it's been a standard format where it kind of discusses what the COLA is and then what the expected benefit is. Well, this year's letter was a little bit different than years past, and it was very confusing. I like connecting with all the retirees, but I don't like it all at once. And I like to have it be on better terms, but a lot of them were very angry and spitting nails because of the quality of the letter and what was in it. So it only really captured it. It kind of suggested that they were only going to receive 1 year of a COLA. They received their COLAs on every even year for 2 years back looking. So it made the beneficiaries seem that they were only going to get half of what they were entitled to.
Well, some of them will only get half because they retired after the thing. But yes, it wasn't our standard letter that we did. We usually do every 2 years, you get this, and here's your flat amount. I think it's 5-point-something% that they're getting.
5.7.
And that came from the town?
Yeah.
It came from.
We had a very short standard letter, so that it was changed this year. That's all I can say.
So the outgoing human resource director had published a letter that was different than what was historically provided for everyone. So everyone, when they saw it, immediately was like, ah! And so I guess my ask is if we can have the new human resource director put a new letter out with the proper language showing the proper COLA rate, so this way they can know what they're supposed to get. That would be helpful. The other thing I noticed too is that the type of mailing that it went, it was bulk, not first class. So
we had a company do it.
So I guess that may have an effect, because if you have a forwarded address, you would have never received the COLA letter if it wasn't first class.
Good point.
So that was something other that happened. So those are two things that kind of need to be addressed, and kind of like my ask, if we could resolve that. Because one of the things we did talk about, especially when we're moving to Millman, was making sure that we do not lose contact with the pensioners or trustees or the,
Was that COLA letter crafted in conjunction with Milliman, or was it or was it just something you guys did, or would it be something?
So,
You know,
I'm not trying to blame the form, I'm just trying to figure out what the process was.
I inquired through a series of emails, and the actuary was named, but I don't think the actuary had nothing to do. I think the actuary may have provided the 3% number, but they didn't craft the letter.
No, I didn't say that, but I mean, I'm saying in terms of the understanding and how, you know, again, would that be an expectation that Milliman would help craft in the future?
I
And say, you know,
I
hey,
think so.
I don't know.
you don't think so?
I would think.
Oh, you would think so, okay, I would too, okay.
Yeah.
All right,
Yeah.
sounds good.
This was just, it was a miss this year.
Yeah, I got
don't
you.
know.
How many people does it go out to?
I think there's how many retirees in the police fire pension plan? I want to say over 200.
Oh, it was just police fire? Or
It was just, well, I know the
Well,
way
there
our
were
trust
Board of
works.
Ed too, so.
I don't know how it works
It went out to
with
some Board of Ed employees get every 2 years instead of every year.
Gotcha. No one complained to me, so I had no idea.
Confusing, that
Well,
letter.
maybe there's an opportunity for us when she's on board and moving, that she would be willing to attend one of our meetings and just, you know,
Yeah.
say hello, and particularly as we're gonna move over toward the Milliman side of the world, and Cheryl's now retired, and
Yeah.
But we should at least ask that the letter get reissued correctly, because that pension,
yeah,
our pensioners
Yeah.
get their payments monthly,
okay.
so they're gonna be coming next week.
Yeah.
And we're getting
Oh.
a lot of phone calls in HR.
Okay,
Okay.
You have
Okay.
That'd be tough.
We will be.
okay, so,
We usually get, okay, I'm getting 3% this year, what is my payment gonna be next month? That has already
Oh.
started.
No.
And
Oh.
that's the way I kind of phrased it with the outgoing human resource director, is that these people are budgeting, and what they're
Yeah.
gonna see is this anomaly,
Yeah.
it's gonna, ooh.
But part two, though, wouldn't the portal for Milliman also be showing them that too? That'd be another resource for them in terms of that?
When that gets up online.
when it's
Yeah,
up
I
on
mean,
the.
I'm not saying it's gonna be there for now.
That'll be- yeah, exactly.
Yeah, a year from now, we'll have
No,
that.
I get it, but I'm saying, but that's
Right,
also gonna be
right.
something that they'll
Well-
have, and that,
You may-
that anxiety.
Look, I'm always a fan of, if we're creating a lot of confusion somewhere, if we can kind of write it, right? Then we should, right?
Yeah, and you may have some people that are, you know, generations before the baby boomers that are
Right.
getting pensions.
Gotcha.
We're-
They're
Okay.
not gonna be getting
Not
online.
going online.
No, I get you, I
Right,
get you.
No,
I'm just saying.
okay, I mean, how, is it,
confused.
is it a difficult thing to
Reissue the letter?
reissue a letter?
I don't think so. I don't know.
The cost.
Jared, what do you think? Can we use it as a request? Is that especially if
Yeah,
it's
I
gonna
just,
result in a
I
whole
don't know
lot
how
of
much
movement.
confusion there's been, or how many people have, how many complaints there have been, I don't know.
I know it seems like there's a time crunch, but on the same token, you don't wanna send another letter that just throws more confusion on it too, so I don't know, I'd rather get it right
I've,
as quickly as possible,
I've
but.
had 20 retirees reach out to me,
Okay.
20?
20.
to me.
Out of
That's
200.
10%?
Well, I don't, yeah, half of, because firefighters are half of the group. I know the police union also, so,
That's busy.
yeah.
That's busy.
Can you, why don't they go to the town
That's what I told them.
and reach out to the town?
They should go to HR.
Yeah.
I mean, I honestly, because
I mean,
I'm only
that-
back part-time right now for fiscal year end, which is a crunch the next
Yeah.
2 weeks.
Yeah.
And to get those letters done and mailed out, they won't get them before July 1st, which is next Friday.
Yeah.
So I don't expect them to
Plus the holiday,
be
so you're
before
gonna
July
go.
1st, but I think that they should at least get them in July.
Yeah.
You know, saying that the previous letter was a mistake, this is what your actual COLA should be, with the proper language that's historically
Right.
been
To
issued.
the languages, right.
Yeah, usually, what we have done in the past, like the annual ones you're due for an annual, you're getting 3%. The biannual would get, if it's, you know, if they're getting 1 year of it, half of it, but this one said the first year was this, the second year was this, so you're gonna get half of this, or it was very
Very confusing.
from what I saw, correct?
No, the letter that I saw looked like it was the one that was sent out for the annuals.
Really? Because I got my annual, it said I'm getting 3%, it was very simple.
Well, that's what I said, I think what happened is that maybe that version of that letter went
Went
out
to
to
your
the police
annual-
fire.
Oh, okay,
You see what now
Yeah.
you know where the confusion is.
yes.
Okay, so this could become a hot spot for the new HR director, right? Because it kind of falls more squarely under the HR and the administration of the benefits, right?
I wasn't aware
Until we
of
moved over
that.
to Milliman. So I would think
They got annual letters.
just a little, even a little heads up or a sidebar conversation of, you know, is there anything you'd like us
Cheryl
to
aware?
do here to?
Did you tell
Yeah,
Cheryl about
it's just hard, it's hard for us to do anything if nobody's
Whoever did the
contacting the
mailing
town
didn't
to
know
let us
who
know.
was
Right.
Like,
annual and who was biannual?
Right, so, but we have to,
What's the
but we
issue
do have
and-
to kind of, to the extent that we've got union reps with us on the board, that's gonna be the direct place. I mean,
Whoever sent out the letters didn't know who was annual and who was biannual.
Oh,
That's what he's telling me,
oh, interesting.
because all his police and fire, except for the chiefs, are biannual, and they got the annual letters. So they're expecting 3%.
This would be a version of a common letter. It's very detailed.
When did they go out, Eric?
A
Last
couple of
week,
weeks ago.
yeah,
So that's a typical letter.
a week ago, 2 weeks ago.
So it
come
talks
Friday.
about the 2-year poll, it talks about
Yeah.
what's coming, and that's not what went out. It was just, hey, listen, you're getting a 3% COLA
Well-
for this year, and that's it.
Okay,
So that's why they're confused, is they
well,
should,
of course.
3% is just for the 1 year, and you have to add the
Right,
second year
right,
in.
you wouldn't know how to add or not add. So, yeah, I mean, everyone benefits from having a little history brought forward, right? If that's a sample letter that's traditionally been done, and this was a different one, and it's caused confusion, let's see if there's, let's see if we can help facilitate the sending out of a,
See if we can help put out this fire.
let's help them out. Yeah, let's help them
I
out.
like that.
Before we get arrested for it.
I was tempted to say that the HR director's probably drinking from the fire hose right now.
Oh.
But I didn't want to say that, because that'd be a
Oh.
Fire water.
I think, I don't know what company sent them out, but I don't think they knew who was annual and who was biannual.
It's a good one, too.
Okay. Well, I think that's kind of a friendly over to the HR,
No, that's
Yeah,
right? It's not a,
annual.
out of our
we will,
purview, but I think it's a friendly over to the HR.
They got the wrong one.
So we've
That's
earned
not
our
it.
pay today.
Look at that.
Yeah.
We've earned our pay.
I can see why that would cause problems, because they're saying I haven't got one in 2 years, I'm only getting 3%.
And our cost of
And I see, now I see your issue.
That's right.
I'll make them aware of it. Well, I'm sure
Oh, my
they're aware of it.
Well, I made Jim aware of it.
Hey,
Oh, well,
No, that was,
well, now we're new.
are we adjourning?
I think,
Any other-
guys, we're gonna adjourn. Okay.
Motion?
Motion.
Motion?
Bruce Ryan, the motion, Carol Trapico, second, we're adjourned.